Hello and good afternoon, and welcome to today's webinar, Trading Your First Option. My name is Scott Green, Marketing Director with Regal Securities. Shortly, I'll be introducing our main presenter, Tony Zhang with OptionsPlay. In today's webinar, Trading Your First Option, we'll be going over topics such as basic option strategies, stock analysis, option Greeks, trading examples, and more. For those who are unfamiliar with OptionsPlay or new with the platform or the tool, OptionsPlay is a tool on your trading platform that was recently relaunched. We've had it on there before. That will help you with your options analysis, strategy, and research for trading options. And since we've relaunched it, it's more highly integrated with your trading platform. And so after I introduce Tony, and he'll show the OptionsPlay platform and go through some of the trading features. We'll have about 15 minutes for Q&A of online chat, and we'll get to as many questions as we can. I'll just take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar will be recorded and is not intended to be used for individual tax, legal, or investment planning advice. So with that, I'll now introduce our OptionsPlay guru, Tony Zhang, the Chief Strategist at OptionsPlay. Tony has over 12 years experience in the financial services industry. He oversees the OptionsPlay developers and that have led to the development of some of the most innovative tools in options trading and analysis. This tool is currently embedded with several major sell-side brokerage firms as well as a direct-to-consumer platform. Tony has built up the product suite and has brought it to market, and he has developed and managed many of OptionsPlay's partnerships. And before I hand it off to Tony, just want to remind or share with everyone where they can find OptionsPlay in their trading platform. You have your tabs across the top, and one of them should read OptionsPlay. If you do not see OptionsPlay tab, please contact your customer support team of your broker, and they'll be able to help address your issue. So with that, I will now hand it off to Tony. Tony, welcome.
Thank you, Scott. Thank you, everyone, for joining me. My name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. And today we're going to be talking about trading your first option. So options trading is something that takes time to learn. So many of you are here today because perhaps you're new to options trading. I just want to first start off by saying that it's not something that you're going to learn overnight. However, what we're going to try to do here today is show you some of the basic strategies that you need to pay attention to as a beginner options trader. I want you guys to understand the best practices as to where to start when you're using options in terms of what expiration dates to use, what strike prices to use. And lastly, what I do want to cover is some of the common mistakes that people make as beginners, so that hopefully help you avoid some of those mistakes when you're starting out. I hope that everyone here leaves this webinar today not only understanding the basic concepts, but more importantly, making sure that you guys feel confident that you have the tools to evaluate what we're showing you guys here today and start using those tools tomorrow in your analysis and start understanding, in your education of options with the OptionsPlay tool that's available to you free of charge through your brokerage firm. This webinar today is geared towards beginners. However, if you are already trading options, this webinar today will also help you as well, because it's going to show you the tool that we're going to provide the OptionsPlay tool and show you how it can help you save a lot of time from your options research. A lot of the things that beginners need to look at for understanding whether this is the right trade for them, you as an experienced trader also need as well. So those tools are shared across whether you're brand new or have experience trading options. And that's really what I hope to spend some time showing you guys here today. The first 15 minutes I'll spend on the slides showing you guys the basic best practices of starting with options trading. But what I really want to try to spend as much time as possible is on the actual platform, because that's the tool you'll actually use to do your analysis and trading. So I want to spend as much time on there showing you some real examples so that you can actually see how to utilize this tool. So when you log in tomorrow to start looking at some ideas, you've already seen this platform, and the webinar is recorded, so you can review the recording tomorrow when you come on and utilize the tool and follow along as you do your research. So I just want to do a quick poll here. If you can type into the chat window yes if you're brand new to options trading, and no if you've been trading options for a while, just so I can get a feel for who's in the room. Just please type that into the chat window. So quite a few yeses, but also quite a few nos. So I would say probably close to half-half, which is great. For those of you that are brand new, welcome. I really hope that this webinar and this tool inspires you to start taking a look at options and better understanding where to start. And for those of you, like I said, for those of you that have been trading for a while, really I hope that you guys learn how to use this tool more efficiently so that you save a lot of time from your research to figure out which options to trade. Okay, so today what we'll cover is, number one, we'll talk about some of the basic strategies. The two I'm going to cover here today is buying calls and puts and selling cover calls. These are the two most popular strategies with traders. Whether you're a beginner or advanced trader, those are the two most popular strategies. So we'll cover that. I'll talk a little bit about the stock analysis piece, because before you can trade options, you must first have a view or an idea of the underlying stock. So I want to cover that, because you can't trade options unless you first have a view on the underlying stock. Then what I want to cover is understanding the Greeks. Now, I don't want to get too in-depth. For those of you that are familiar with the Greeks, I really want to cover this on a fairly high level so that we're not scaring anyone off. And part of that is also because the Greeks, you no longer need to calculate these things manually anymore. When I learned how to trade, a lot of the calculations we had to do on the back of an envelope. Nowadays, tools like OptionsPlay do all the calculations for you, so you just have to understand them from a high level. You don't need to know how to calculate them. And then we're going to cover what are the common mistakes that people typically make when they're starting out with options, and then we'll wrap this up by showing you guys how to find these strategies using OptionsPlay. So let's go ahead and get started. Basic strategies. So if you're starting out with options, there's two primary strategies that you want to segment into. The first is buying calls and puts. This is a strategy where you would typically deploy if you have either a bullish or bearish view on an underlying stock. So normally, if you were bullish on a stock, you would buy the stock. If you were bearish on the stock, you may short the stock if you have the ability to do that. With options, what you would do is, if you're bullish, you would buy calls. If you're bearish, you would buy puts. So for those of you that are brand new to options trading, we'll cover kind of what that actually means. But a call contract gives you the option to buy that stock. A put contract gives you the option to sell that stock. Now, when you're buying calls and puts, there's two things or any option strategy, there's two things that you need to pick. You need to pick an expiration date, and you should need to pick a strike price. So a lot of people ask, what expiration date should I choose? And that ranges anywhere from 1 week to about 2.5 years out. So you have a lot of time to consider as to how bullish you are and how bullish you are for what period of time. So usually, as a good starting point for basic beginners who are starting out buying their first calls and puts, is you generally want to go about 1 to 2 months out in terms of expiration dates when you're buying calls and puts when you're starting out. And in terms of strike prices, you want to buy strike prices that are slightly in the money. So strike prices that are just in the money for, or just slightly below the current price for the calls, and strike prices that are just slightly above the current price for when you're buying puts. And we'll show you some examples of this using OptionsPlay in a few minutes. The second strategy that I want to cover is cover calls. Now, this is a strategy that's completely different. It's the generate income. So this is actually by far the most popular strategy amongst traders, is selling cover calls, selling calls against the stock that you currently own in your account to generate some income. This strategy does require at least a minimum of 100 shares of the stock that you own. So if you have some stock in your account that you only have 50, 60, 70 shares of, this is not a strategy that you can deploy for that. And lastly, you do risk losing your stock, meaning you do have the risk of selling the stock at a specific price by generating income by selling covered calls. But these are the two primary strategies that you would deploy if you're starting out with options. You're either buying calls and puts because you have a directional view on the underlying stock, or you can sell cover calls because you want to generate some income on the existing stock position in your account. And cover calls is really actually where I want to spend a little bit of time here today, because this is the one strategy that if you have any stock in your account, this is a strategy that's a good place for anyone to start, because it doesn't necessarily require you to have a directional view on a stock, because sometimes you just may not know where a stock's going to go, higher or lower. But you probably all own some stock in your account, and cover calls is one way to utilize options to generate some income for the existing assets in your account. So, like I said, one of the most important factors of trading options is to first understand the stock analysis, meaning having a view on the underlying stock. And the direction of that stock, meaning the direction that you feel the stock's going to go in, is actually the most important factor when you're trading options. Without a directional view, it's difficult to trade options. There are certain strategies that you can trade that you don't need a strong directional view, but those are not necessarily strategies for beginners. So for beginners, you generally have to have a view on the underlying stock. So if you're bullish on a stock, you buy a call option. If you're bearish on a stock, you buy a put option. And the second part is having an exit plan. And what I mean by that is, if you feel that the stock is bullish, you should have a target price. You should say that if you're bullish on Apple, which is trading around 190, you should say, I think Apple's going to go to 200 or 220 or whatever that target is. You need to have a target, because that's going to help you lay out your plan as to when to buy that option and when to sell that option. It's really not that different from buying stocks. The only difference between buying stocks and buying options is that you have a time factor built into the option. So you have to get in and out at a certain time or get out by a certain time, versus when you buy a stock, you can hang on to that stock indefinitely. You don't have to get out at a certain time. So because of that time factor that's built into options, you must have an exit plan. Okay, so what I've broken down here is two primary ways that people typically like to analyze stocks. You have technical analysis. This is for those of you that like to use charts. Charts or historical data to try to anticipate where the future price of a stock is going to be. Most technical trades or most technical traders tend to be more on the shorter end of the spectrum. These tend to be more shorter term analysis, or what we would call swing trades. And for those types of trades, you would typically choose expirations that are anywhere from 1 to 3 months out. So when I'm talking about having an exit plan, that just means that you have a target price that's likely going to be reached sometime in the next month or 2 or 3 months, versus someone who's more of a fundamental analyst. So for those of you that like to look at balance sheets and income statements and try to get a feel for whether a company is overvalued or undervalued, these tend to be much more longer term, because if you think a company is undervalued, it can take 3, 6, 9, even a year, 3, 6, 9 months, or maybe even a year for that company to become fully valued. And because of that, because it takes longer for that type of analysis to come to fruition, you typically want to trade longer term options. So anywhere from 3 to 12 months out is a good starting point if you're a fundamental trader. So depending on how you typically like to do your analysis for the underlying stock, that will typically dictate how far out you would typically buy when you're buying a call option or a put option. So just keep that in mind when we're looking at different strategies to help you decide which expiration and which strike price to choose. Next, what I'm going to cover is the Greeks. Now, this is usually where we lose a lot of people. However, again, what I want to do is I want to keep this at a very high level, because where we typically lose people is when we start getting into the math. And a lot of people I know don't like to do math, but that's okay. The platform or the technology these days does all the math for you, so you don't have to do any of the calculations yourself. But these are very important concepts to understand when you're trading options, because they are very different than when you're trading stocks. Okay, when you trade stocks and it goes up by $1, you make $1. If the stock goes down by $1, you lose $1. So it's very straightforward, but it's not the same when you're trading options. So the two Greeks that you want to make sure that you understand is delta, which is the change in the option price with respect to the change of the stock price, and theta, which is the change in the option price with respect to time. So what delta tells you is how much are you expecting to make or lose on the option for every $1 that the stock moves up or down. So in this example here, I have an option that has a delta of 0.5. What that tells me is that for a move of the stock going up or down $1, the option price will move 50 cents, exactly half of that. So meaning if I bought a call option and the stock goes up by $1, my option is going to rise by 50 cents. Conversely, if I bought that call option and the stock drops by $1, my option is going to lose 50 cents. So this is really just telling you how much you can expect the option price to move with respect to how far you think the stock's going to move. So for example, if I think the stock's going to move $10 higher, then I can expect that my option will move up by roughly $5. That allows me to calculate what my potential reward is, what my potential risk is. But however, like I said, you don't have to do any of these calculations manually. The OptionsPlay tool, which we'll show you in a minute, does all of these calculations for you. These are just important concepts to understand. Theta is the other concept that is different from when you're trading options versus stock, because like I said, when you buy a stock, you can hang on to that stock indefinitely. If the stock doesn't move, you don't make any money, you don't lose any money. With options, that's not the case. The option price will continuously decay as time goes. So the price of your option actually loses value as time goes on. And that's really what you're fighting against when you're buying options, and that's what's working in your favor when you're selling options. So this is really why there's two different camps between buying options and selling options. When you're buying options, you're trying to overcome this time decay. When you're selling options, you're trying to capture this time decay. And theta is simply just measuring how much does the option decay by for every day that goes by in time. So this is usually measured in cents per day. So you'll see a theta of 0.05, and what that simply means is that the option price loses 5 cents for every day that goes by. So if you're an options buyer, you need to overcome this 5-cent loss every single day with delta. So if the stock moves up by $1, you make 50 cents. That buys you roughly 10 days worth of time decay, if you will. Vice versa, if you're a seller of options, every 10 days goes by, you make 50 cents. So this is theta tells you how much money you make or lose as time goes by. So let's talk about what are some of the common mistakes that people make when they're trading options. And what I've done is I've broken down into the two sections: buying options and selling options. So like I said, when we're buying options, this is where we're buying calls and puts because we have a bullish or bearish view on an underlying stock. One of the most common mistakes that people make when they're buying options is they hold on to this trade until expiration. So right now it's June. Let's say you buy a July or August option. Let's say you buy a call option on Apple because you think the stock's going to go higher. A lot of people, when they're starting out with options, is they'll hold on to that option until August or until expiration. When you're buying options, you typically want to get in and out before expiration. You generally do not want to hold these trades until expiration. And the reason for it is because of that theta, that time decay that continuously works against you. If you hold it all the way till expiration, you're going to suffer a lot of time decay. So meaning the stock really has to move significantly higher in order for you to overcome that time decay. And that's always a difficult thing to do. So what you want to do is you want to time buying and selling that option with when you think the stock's going to move higher. Once it hits that target price, you get out. You do not hold it until expiration. The second common mistake that people make when they're buying options is they tend to use expirations that are too short. Anything less than 2 weeks is probably way too short to use. A lot of times, you may have maybe you have a technical swing trade and you think the stock's going to move higher 10 points over the next couple of weeks, so you buy a 2-week option. The problem with that is sometimes that might take 2 weeks, sometimes it may take 3 weeks, sometimes it may take 4 weeks. If you don't have a good grasp on that, you always want to give yourself a little bit more buffer, a little bit more time, so that if the stock doesn't move in the expected time frame and it takes a little longer, you have that time buffer, if you will. So you generally want to go out at least 2 weeks beyond where you expect the stocks to move. So if you think the stock's going to move 10 points in 2 weeks, I would buy a 4-week option. Go a few weeks past that so that you give yourself a little bit more time. And lastly, the most common mistake I see with users buying options is not having an exit plan. Meaning you think Apple is bullish, it's trading at 190 right now, and it goes up to 200, and you don't really have a target price, so you don't really know when to exit that trade. And that's really one of the most common mistakes that people make when they're buying options, is not having a target or not having an exit plan, so they just hang on to it. And what happens next is that they hang on to it for too long, and maybe the trade goes in their favor, but they end up giving away a lot of those gains to time decay. So not having an exit plan is one of the worst things you can do when you're buying an option. When you're buying an option, you need to have an exact entry plan and an exact exit plan. So those are some of the things to look out for if you're buying calls and puts because you have a bullish or bearish view on an underlying stock. When it comes to selling options, if you're selling cover calls against some stock that you own in your current account right now, the number one mistake people make is using too aggressive calls, meaning calls that are too close to the current price. And people do this because selling aggressive calls yields a higher amount of income. And higher income always looks attractive. However, higher income comes at a substantial cost, and that means that you typically have to sell your stock at a fairly low price. And this is something that I'll explain to you in a few seconds, but selling too aggressive calls usually ends up having your stock get called away. A lot of times the stock maybe shoots pretty significantly higher and you're not able to participate on that because you've sold your stock at a relatively low cost basis. And this is all because you were trying to chase too much income in a short period of time. Second mistake people make is using expirations that are too long. So when you're selling cover calls, people tend to do the exact opposite of when they're buying options, is they go too far out. Because again, when you go very far out, you're going to get more income. But when you go very far out, you're not going to be able to get as much premium as if you sell 1 month calls multiple times. So that's why we usually tell people when you're selling options, you want to stick to options that are about 1 to 2 months out, not too much further than 3 months out. If you go too much further out, you're basically giving up a lot of income and putting it off the table. So that's why we generally recommend if you're selling covered calls, use expirations that are about 1 to 2 months out. Lastly, same thing with selling options is not having an exit plan, because you should understand what happens if the stock goes higher, what happens if the stock goes sideways, what happens if the stock goes lower, what are the plans for each one. Understanding each one of those is critical to success with trading any option strategy, specifically selling options. So making sure that you understand what to do in each one of those 3 scenarios is really important. Now, we cover all of these things in a separate webinar. So we actually have a webinar just on cover calls, and that's actually one of the ones that's going to be coming up soon. So I highly recommend, for those of you that are brand new to selling cover calls, please attend that webinar. We're going to get much more in depth into the intricacies and nuances of selling cover calls and how to go about doing that consistently. So make sure that you sign up for and register for that webinar. So let's actually jump over to OptionsPlay, because that's really where I want to spend most of my time. Because this is the tool that you'll actually be using when you're trading options. You're not going to be looking at a PowerPoint presentation if you're trading options. So what I want to help do today is bridge that gap between the educational piece and the actual practical piece of doing what you're doing the research on the underlying stock and actually placing an options trade. So like Scott said before, to find the OptionsPlay tab, it's here on the upper right-hand corner. If you don't have it, you can always add it as a widget as OptionsPlay under the Add Widget tab. And if you don't see it, again, please contact your customer rep. They'll be able to help you with enabling that. So what you see here is the OptionsPlay tool. It's divided into 3 sections. We have trade ideas and watch list here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. Now, we created this platform. We started this company 5 years ago because we wanted to change the way people analyzed, explored, and really looked at options trading. And specifically for beginners, we realized that when you're looking at an option chain, and for anyone who's ever traded options, you've probably seen this page where it's just pages and pages of expiration dates and strike prices and numbers, and it's kind of like staring at a phone book. Trying to figure out exactly which strike prices to buy, which strike prices to sell, and there's all this data to try to help you do that, but a lot of times it just becomes more overwhelming than helpful. So what we wanted to do is create a different way to analyze the same data that's a little easier. And what we basically understood, or what we saw, was that looking at the option chain is kind of like searching for something in a phone book, and we no longer look things up in a phone book anymore. We simply just search for what we want, and something goes out and finds it for us. And that was the same philosophy that we had with OptionsPlay. Is if we just simply asked you a simple question like, are you bullish or are you bearish on the stock, then we can present strategies that make sense to you, as opposed to having you search through the phone book. And that's really what I'm hoping to show you guys here today. So trade ideas and watch list here on the left, that's telling you what symbols to take a look at. So trade ideas are fresh symbols with bullish and bearish ideas that are scanned for you every day. Watch lists are watch lists that you've created on your own. So you can come in here and create your own watch list. I highly recommend you to create a watch list with the stocks that you own. The security analysis panel here in the middle is designed to help you provide a quick snapshot of what's currently going on with the stock. We provide trend analysis, so you can see not only what the current 1 month and 6 month trend analysis is, but we also actually show it to you historically on the chart, so you can see not only what the current trend analysis looks like, but how does that change over time. So here, as you can see into it, it's 1 month and 6 month trends are bullish, and it's been bullish for quite some time, ever since early April, when things were looking a little neutral, and then right here in mid-April when things turned really bullish on Intuit, which is not a surprise. Right after April 15th or April 18th, when we had to file taxes, that's when Intuit stock really kind of took off. And Intuit being TurboTax, for those of you that are not aware. And then we provide different analysis to help you provide a directional view, so a technical score to give you a relative strength reading, so that you can quantify how strong this stock is compared to other stocks in the market, so that you can quickly gauge, am I bullish or bearish on the stock? And what we do is, as you can see, you have 2 buttons here at the bottom of your screen. One says I'm bullish, one says I'm bearish. No matter which one you click on, we will present to you 3 strategies. So the 3 strategies will always be buying the stock. So for those of you that are brand new to trading options, this is the strategy that you're most familiar with. This strategy here in the middle is the simple call strategy. This is what I was referring to, buying a call if you're bullish on a stock. And then for those of you that are a bit more advanced, here's a multi-leg or a more complex strategy called the call vertical. If you're brand new, I would just focus here on the middle strategy first before you graduate onto the more advanced strategy. But our tools are designed to help not only provide you with a starting point, so all you have to do is type in a stock, click on whether you're bullish or bearish, and we will go select a starting point for you, both an expiration date and a strike price that makes sense as a starting point. This is not to say that this is the best strategy to trade, but this is designed to save you time, so that you're not typing in a symbol and having to scroll through pages and pages of this just to find a starting point. Let alone, a lot of times when you're looking at a strategy like this, you might want to compare one expiration to the next or one strike price to the next, and it's really difficult to do that from the option chains. Our tool is designed to allow you to modify any strategy. So if you want to change this call option to maybe a different call option, you want to compare buying the July 210 call versus the 200 call, you can put any 2 strategies side by side. And what we do is we use our P&L simulator that's designed to say, Intuit's trading at 207 right now. What happens if I think it's going to go to 215? What are my expected returns? So if I had bought this 210 call option, I'd make a 13% return. If I bought this 200 call option, I make a 41% return. This allows you to compare any two strategies side by side and say, what happens if the stock goes higher? What's my expected returns? What happens if the stock goes lower? What are my expected losses? So that you can quickly see and compare any two strategies side by side. And that's really the power of OptionsPlay. So let's go through a few examples here. Let's look at Duke Energy. And this is just for illustrative purposes. This is not by any means a solicitation to trade these securities, and I don't necessarily have a view on these securities. I'm just using these as illustrative examples. But as you can see, Duke Energy, it's got a technical score of 2, telling me this is a weak stock in the overall market. 1 month and 6 month trends are bearish. It's been bearish for quite a few weeks now. So if I was looking at this particular stock, I might be looking for some bearish opportunities on this, and I can click on I'm bearish. So now I can either short the stock here on the right-hand side, I can buy a put strategy, or I can buy this put vertical. So let's focus on just the put because we're talking about basic strategies. So traditionally, if you were bearish on the stock, the only choice you would have is to short the stock if you could only trade stocks. However, now let's take a look at what happens if you bought a put option instead of shorting the stock. So let's take a look. Duke Energy is trading at 72 right now. Let's say I think it's going to go down to $70, or there's not much to go on. It looks like the stock has really taken a beating and it's at its 52-week low here. So what if, let's say I think it's going to go down another 5 points to maybe 60, 67 or 68. So, or let's go to 68. So if let's say I think the stock's going to move down to $68, which is roughly $4 over the next 45 days or so. This is July 20th expiration, so a little about 37 days or so. If I had shorted the stock, I make a 5.8% return. And shorting the stock obviously has additional costs to do that as well. You have margin interest and other things to consider. Aside from that, you're looking at about a almost 6% gain if you had shorted the stock. But if you had bought the put, you'd make a 200% return, because shorting the stock requires a significant amount of margin to short that stock, but buying a put only costs you $150. So no matter, and the great thing about trading calls and puts is that your risk is completely limited to what you've paid for the option. So when you pay $150 for a put or $150 for a call, that's the most amount of money you can risk no matter what. And that basically means that if, let's say, we're completely wrong on our analysis and Duke Energy goes up to back up to 79, which is where it was just a few weeks ago, as you can see here on the put option, I lose $150, meaning what I paid is the max amount of loss. Even if the stock goes to 1,000, I can only lose $150. That's one of the good things about trading options or buying options is that your risk on your option that you buy is the maximum amount of money you can risk. Versus, look at here, if I had shorted the stock and the stock really went against me, I'm losing $677, and my losses are unlimited, meaning if the stock continues to go higher, I will continue to lose more and more money. And that's really why buying a put option is a more attractive trade a lot of times than shorting the stock, because you get the same upside if the stock goes in your favor. So as the stock continues to go lower and lower, you're going to make more and more profits on your put. But if the stock goes against you, you're capped in terms of your risk. So that's really one of the benefits to consider buying a put option versus shorting a stock. Let's take a look at another stock here, Eastman Chemical. Material stock, as you can see, a technical score of 8, telling me this is one of the stronger stocks in the market. 1 month and 6 month trends are bullish, telling me that the trends are not only is this a strong stock, it's continuing to trend higher. So let's take a look at this stock. It's trading around 109 right now. Here I can buy 100 shares of that stock. It would cost me $11,000. That's probably, and it's currently at 108, but this is probably after hours bid ask. So let's just say it's $10,800 to buy 100 shares versus only $480 to buy one call contract. That's something that's an attractive thing to consider taking a look at if you're trading options, so that you can, instead of shelling out close to 10 or a little over $10,000 to buy 100 shares, you only have to put up $480 in capital to buy a call option, which gives you the same upside if the stock goes higher. But if the stock goes lower, your risk is capped to the $480 that you've paid for this option. So this is roughly 5% of the underlying price to buy one call option. So Eastman Chemical is trading at 108. Let's say you think this is going to go up to at least maybe this 52-week high level, which is around 112.5. And this is the part where I was saying that you don't need to do any calculations yourself anymore, because our tool does all of these delta and Greek calculations for you. You don't have to know that this option has a 50 delta, and if the stock goes up $10, your option will go up by $5. It does all of that calculations for you. So here, if you had bought the stock, it says here you make a 0% return, because again, that's based on after hours bid ask. But if you had bought this call option, you make a 56% return. So I would imagine that if you had bought the stock, you'd be up about 4% or so, 3% or so. But if you bought this call option, you'd be up 56%, versus for those of you that are a bit more advanced and looking to trade verticals, this is an option that you can take a look at. It cost you slightly less money, so $480 versus $455, so reducing your risk a little further. And what that does is it actually increases your return. So instead of making a 56% return, you make a 64% return by buying that call option. And the best part about our platform and the integration that we've done with Regal is, if you click on the trading tab, this is one of the things that I was talking about in terms of avoiding the mistakes that beginners make. Is we have a strategy checklist. This is designed so that it checks for a bunch of things before you place a trade, so that you know the risks you're taking before you place a trade. So you're trading with the trend of the stock, you're trading with the trend in the market. The OptionsPlay score here is good. There's no earnings between now and expiration. That's another thing that a lot of beginners tend to overlook, is not checking to see if there's earnings between now and expiration, because if there is earnings, that impacts the option price significantly around earnings. So it's important to understand that. We also have a specific webinar just for trading earnings coming up soon, so make sure you attend that. And lastly, spread and liquidity. When you're trading stocks, you may not be as concerned about the liquidity of a stock, especially if you're just doing a couple of hundred shares. But when you're trading options, liquidity is something that is more, you need to be more cognizant of. So for example, if we look at the bid-ask spread here, it's trading at 420 by 480. So it's a 60-cent spread on a $4 trade. So from a percentage perspective, that's a fairly large spread that you're paying. So it's really what we want to do is help you try to minimize that by showing you that you want to place your orders near the mid price to minimize your cost from the transaction cost. So making sure you understand these risks before you place a trade. So if you're brand new, make sure you check that strategy checklist. And once you're ready to place that trade, you can click on the preview order button. I don't know why that didn't work here. I'll find another security here. But basically what this does is it actually pre-fills a ticket for you. Let's see if we did the other example here, if that works real quick. It was Duke Energy. Like I said, if you were ready to place that trade, you click on the trade button, check out the strategy checklist. Once you're ready to place that trade, you can hit the preview order button. And what that does is it actually pre-fills that ticket for you. And this is designed to save you time and also make sure that you reduce the amount of mistakes that you make on an order ticket, because when you're trading options, there are 6 parameters that you need to enter: buy to open, quantity, expiration, strike price, call put, and the order type. Sometimes it's not that difficult to screw one of those things up. You might pick the wrong expiration date, the wrong strike price, perhaps even the wrong action. If you do that, you end up flipping the strategy altogether. By using OptionsPlay to analyze the trade so that you see exactly the trade that you want to make, clicking on the trade button, hitting the preview order button, that's designed to really minimize the chances of making mistakes. Okay, so that's just a basic idea of how to utilize our platform for if you're bullish or bearish. You type in any stock, You look at maybe the trend analysis and the relative strength analysis, make a feel or gauge where you think the stock's going to go. Click on either I'm bullish and see the 3 bullish strategies, or click on I'm bearish and see the 3 bearish strategies. Use the P&L simulator that allows you to say, hey, I think the stock's going to go higher, or I think the stock's going to go lower. See what your expected return is. Once you feel comfortable with the trade, hit the trade button, and the preview order button allows you to enter that trade directly into your platform without having to do any more work. So now let's talk about selling covered calls. So that is for those of you that are traders and you have directional views on a stock, but many of you, you might not be traders. Maybe you just own a bunch of stock in your account. You tend to buy and hold those stocks, and you're not very active in your trading, and that's okay. You can still utilize options, because this is actually one of the more popular ways to use options, is to generate income on the stocks that you own in your account. And I highly recommend, even for those of you that are currently trading options, if you're not selling covered calls, it's a strategy that you should really utilize, because it allows you to generate income on the assets that you currently hold in your portfolio. So one of the things you can do is create a watch list with all the stocks that you own. So here I have a covered call watch list. These are some of the stocks that many of you may own in your personal accounts. What we have is an income settings button. This allows you to create your personalized settings for your covered calls. So like I said, by default, we'll always choose shorter term options, because based on our back test, those will yield you higher results or higher returns in the long run. And we also select your risk tolerance as optimal to start off with, so that you're not too conservative or not too aggressive, but you can always adjust these yourself. And like I said, we do a separate webinar specifically on this topic, so I highly recommend you to come view that. And then you can set these independently for those of you that like to sell puts, but I'm not going to cover that here today, because this is talking about basic strategies. So when you set your settings, you can save them as default. All you have to do now is click on a stock that you own. Let's say you own some Johnson & Johnson. And what it does is, instead of having to go through the chains, search for an expiration date, search for a strike price, it basically does all of that for you. It basically returns which expiration and strike price meets your criterias and best suits you. So here, as you can see, it'll ask you, do you own shares of Johnson & Johnson? You click on the yes button. You can type in the number of shares you own. So let's say you own 300 shares of Johnson & Johnson. And what it does is it goes out and it finds the cover call that best suits your criterias and tells you which calls to sell. So if, let's say, you own 300 shares of Johnson & Johnson, what this is telling you to do is that by selling the July 6th 127 cover calls, which is roughly $5 above the current, or $4 above the current price, which is at 122. They will produce a 4.53% annualized return, and based on historical volatility, there's an 84% chance that this calls will expire worthless. So basically, this stock currently pays you roughly 2.9% dividend yield. By selling a cover call, you're going to be able to add an additional 4.5% yield on top of that almost 3% you're yielding on Johnson & Johnson, which brings your 12-month projected yield to a little about 7.5%. So this is really why cover call traders like to use this type of strategy to generate income, because it boosts the yield in the stocks that you have in your account, especially stocks that don't pay any dividends. So for example, let's say you own Facebook right now, and many of you probably do, you're getting 0 dividends on a stock like this. So by adding a Facebook's trading at 192 right now, this is telling you to look at selling a July 6 200 calls. This basically says that if the stock is above 200 on July 6, you're going to sell the stock at 200, which is an $8 profit in just a few days, $8 per share. And what that yields is almost 9% yield. So if you're able to sell this cover call throughout the year, you're going to gain an additional 9% yield roughly on your stock, on a stock that currently pays you 0. So this is why this is one of the more popular ways to utilize options, because you don't have to have a directional view on Facebook. You just have to own the stock, and you can continuously sell calls month after month and generate some additional income. So if you own the stock, you can generate $108 in income for every 100 shares that you own in the next 23 days. And if this call expires worthless, you can come back and do it again and again and again. And that's really what drives the income stream that people derive from cover calls. And that's why this is one of the most popular strategies of how to utilize options, especially for beginners, but even for all traders. This is the single most popular option strategy to use. And our tool is designed to make that process as simple as possible for you. All you have to do is put in your income settings, type in the symbol that you're looking at, and we will go out, scan the option chains for you, and return back to you what is the cover call strikes and expirations to look at. So if you own IBM, this is telling you to look at the July 6th 150 cover calls, generates roughly a 6% yield on a stock that pays a really healthy 4% dividend. So you're increasing your yield from 4% to a little over 10% by adding cover calls. That's why this is such an attractive strategy, especially for users who may not have always a directional view on an underlying stock. Selling cover calls, you can do them in pretty much all market conditions, regardless of whether you're bullish or bearish on the underlying stock. So with that, I just want to wrap up and sum up real quick. If you're looking to use our tool for trading strategies, you want to click on the Trade tab. This allows you to basically type in any stock, do some analysis on the underlying stock, and you can click on either I'm bullish or I'm bearish. We'll present to you 3 starting points. For those of you that are a bit more advanced, you can take a look at the call vertical here on the right, or you can always modify and you can choose any of the strategies we have using our strategy constructor. So if you want to look at diagonals or ratios or all types of trades, even credit spreads, a lot of you like to trade credit spreads, set up some credit spreads and be able to compare trading credit versus debit spreads. Our platform is really powerful from that perspective, but I'm not going to get into that here today. We will have a separate webinar on that. And then for those of you that are looking to trade income, clicking on the income tab, we'll present to you always the cover call or the short put opportunity for those of you that are looking to generate income. And then lastly, before you trade anything, clicking on the trade button, viewing the strategy checklist is really important for those of you that are brand new, because the strategy checklist checks for a few things that you might not be familiar with or know to check before you place your trade. And all you have to do is hit the preview order button, and that will pre-fill the ticket for you so that you can instantly place that trade in your account. So with that, what I'm going to do is I'm going to wrap this up and I'm going to open this up for Q&A. Please type into the chat window if you have any questions regarding anything that I just spoke about, and I will answer any questions that are already in the queue. So is delta always consistent on a stock, or does it change? The delta constantly changes. The delta not only changes with respect to the stock, it also changes with respect to other things. And there's in actuality, there's about 20 different Greeks that you can potentially look at. But in reality, what we're really focused on is delta and theta. But they do change a lot. And that's why we say, don't try to do the math yourself. Let us help you do it, because it's just too many things to calculate manually. Great question. Do you do just calls or puts, or can you also help with spreads and straddles? So I just showed you here before, all strategies are available when you click on the trade tab. You know, we have all types of strategies. You can do straddles, strangles. You just click on modify, strategy constructor, and you can construct all types of strategies: condors, butterflies, straddles, condors, you know, all types of strategies. Are we able to adjust the support and resistance lines on the chart? No, you're not able to adjust it. These are simply ones that we've calculated for you. You know, we've spent a lot of time building these support and resistance lines on our charts because no one else has these types of support and resistance lines. These are true support and resistance, not just based on things like moving averages or things like that. So they are drawn for you, and you can move your mouse and actually see how far does the stock need to move in order to hit that next support or next resistance level. I saw an OTO and OCO on your platform. So that's referring to the platform. We are just the OptionsPlay tool within the platform. So if you have a question about an OTO or an OCO order, please contact your account rep. They'll be able to help you with that. Is there a list is there a list and tutorial somewhere on services offered by eOption? So if you're referring to with respect to OptionsPlay, all of our webinars are recorded. So that is something that I do recommend you to take a look at, because we do have a lot of material so far now covering things like earnings, cover calls, directional plays, debit versus credit spreads. So we have a lot of different webinars, and all of them are available to you. So I'll have Scott send everyone a link after this webinar so that you guys have access to all the replays, not just this one, so that you can view those. Will you show how to sell back the option in another webinar? Sure. So that's actually a question I think more so geared for your account rep. So please contact your account rep, and they'll be able to show you how to do that exactly on the trading platform. First, I have been testing the new OptionsPlay. My experience is that you need to sell and close an option 30 days from expiration, or the option quickly loses its value. I have played with OptionsPlay and I really like it, but gun shy on choosing a weekly or monthly option. Let's say July 27th call from today. Just my experience, if the stock does not move in a week, you won't be able to sell it once the 30-day window starts. So that's exactly my point about making sure that you have an exit plan before you get into that trade, meaning you should time your buying a call or a put when you expect a move to happen. If that move doesn't materialize, you need to get out immediately. So you're absolutely right. This is why I wanted to bring up the concept of theta, even though it's not something that a lot of people like to talk about, and it kind of tends to confuse people. But theta actually accelerates as you get closer and closer to expiration. So you actually lose more and more money per day as you get closer to expiration. That is why one of the most common mistakes that you want to avoid when you're trading is holding onto a trade until expiration. You do not want to hold on to a long call option into expiration. So very good point. Thank you, Robert. Can you talk about exiting the play? So if you're talking about buying a call or puts, the most important thing, like I said here before, is having an exit plan, and that's based on your analysis of the underlying stock. So let's go through this. Let's do the Duke Energy example that I had here, right? So Duke Energy, it's a very weak stock, just made a new 52-week low today, I believe, or yesterday. So, my analysis is that I think this thing's going to continue going lower. I think 73, which is the prior 52-week low, is kind of a new resistance level. So basically my plan here is I think it's going to move down to about 70 or 69. So in terms of having an exit plan, that just simply means that if I buy this put option and the stock drops to 69, no matter what happens, I got to get out of the put option. Conversely, if the stock goes back above 74, 73, 74, that's when I can say my analysis initially was wrong. It's also time for me to exit. So you need to have an exit plan, both if you're correct as well as if you're wrong. So, and that's usually, and the reason I like to use technical analysis is because that gives me a very clear indication as to when I'm wrong or when I'm right. Well, as a fundamental trader, to say a company is overvalued or undervalued, it's really difficult to say, hey, I'm right or I'm wrong. There isn't a real easy point for you to determine that, versus when you're using the charts, it's really easy for me to say, hey, my analysis was wrong or my analysis is right. Either one, that's my plan to get out. So just to be clear, if you have any questions regarding placing orders or types of orders, anything like that, that's a question for you to direct to your brokerage firm. I'm here just to help you guys with the OptionsPlay tool. I'll try to answer as many of those questions as possible. To modify an order, that's all under your positions and orders. You can do that. You can modify and change all of your orders here. But again, best place to ask that is your account rep. They'll be able to help you with that. What is the risk on a cover call? You said you may lose the stock, but you would be paid for that, right? So not really losing money. That is absolutely correct. You're never losing money on a cover call. So the only thing what you're doing is you're giving up opportunity. So for example, like I said with Apple, if I sold the $200 call, then what I'm doing is I'm giving away any potential rewards above 200. So it's not a real loss. It's not a realized loss. I would consider it as a lost opportunity per se. But you're absolutely right. You're not really losing money when your stock gets called away. You're actually making money because you've sold your stock at a higher price. To that point, if OptionsPlay is recommending an 80 to 100 score on a July 27th strike, is the program saying it's confident the stock is going to enter the in-the-money phase and still give enough money to exit by selling? So no. So the OptionsPlay score is just telling you what the risk to reward of that trade is, and the OptionsPlay score tells you whether how well balanced that risk to reward really is. And it's designed so that you can compare two strategies that you traditionally wouldn't be able to compare. Because if you bought a call, you have unlimited reward. So a lot of people don't know how to calculate risk to reward on something that has unlimited reward. So what we do is we take what is likely going to happen in this particular scenario. We're not going to assume the stock's going to go to infinity. We're going to say, what happens if the stock stays within a relative range? What is your expected reward? What is your potential reward of the amount of green you see on your chart versus what is your potential red, which is your potential losses? And we weight the two, and that's really what we're telling you is how well balanced those two risk rewards are. I have a question here is, I have seen where the OptionsPlay recommends an option strategy just 45 days out, only giving about 10 to 15 days before you need to sell the option. Why is the program placing a recommended strike so close to today's date? So I didn't say that you have 30 days left. I think someone else said that. I just simply said that you shouldn't hold a long option into expiration. So you can hold on to it for 30 days and, get out 10 when you have 10 to 15 days left. So like I said, this is all, you should always use an expiration that's about 2 to 3 weeks beyond your expected time horizon. So if your expected move on a stock is 3 weeks, then trade a 5-week option. If your expected move is 3 months, then trade maybe a 4-month option. It all depends on what your views on the underlying stock is. We start out with 45 days out because most option strategies are traded between 1 to 2 months out. That's why we choose the 45-day option as your starting point. We're not saying the 45 days is the only way to trade it. We're just saying that that's where most people start out. That's why we're starting you off with the 45-day option. Pat, thank you very much. How easy is it to place a multi-leg trade once you have decided the trade, vertical spread or iron condor? Do you have to enter each leg separately? No, not at all. So that's one of the great things about our platform is if, let's say you wanted to place this, vertical, or let's look at the condor since you brought this up. So let's say you want to trade this call condor, right? Once you've created this strategy in our platform, which you can do just by the click of a mouse using our strategy constructor, all you have to do is click on the trade button, hit the preview order, and everything's pre-filled for you. So that's why I'm telling you to use OptionsPlay. Because if you're trying to create a condor on an option chain, it's going to take you a while to figure out, hey, I'm going to buy the 85, then I'm going to sell the 195, then I'm going to sell the 210s, and sometimes you screw up and then you buy this, right? So that here's a condor that I just created on the chains. But one of the things about the chains is, what if you wanted to change all the strikes down one? Then you got to do a lot of clicks. Then I got to buy this one. Well, first I got to uncheck these. Then I got to buy this one. Then I got to uncheck that one. Then I got to buy that one. So there's a lot of manual clicking to move all the strikes up or down one using the chains. When you're using OptionsPlay, if you want to move all the strikes up one on a condor, you just click on the strike button. So you click on that and it moves all the strikes up one. You want to move all the strikes down one, you just do that. You want to change the expirations, just click on the right arrow to change all the expirations, the left arrow to move the expirations in. This is why we came up with the name OptionsPlay, because when you're trying out different options, it's like playing with the different strike prices and expiration dates, and you might want to change a wider condor. And if you do that, all you have to do is click on the trade button. Everything's pre-filled for you right here in the order ticket. You don't have to do any of that manual clicking on that option chain. So especially for those of you that are trading more complex options, you will find OptionsPlay is a much easier way to navigate the different options, the different strike prices and expiration dates versus using that option chain, in my opinion. What are automatic exits? If in the money at expiration, will it be exercised or sold? So Chad, that's a very specific question. It really depends on whether you're long or short the option. And it depends on a few different factors. So I think the best thing to do is to call your customer service rep, talk to them about your specific scenario that you have in mind. We'd be able to walk you through that. What is the requirement to open positions by selling either a put or a call instead of buying a put or a call? So there isn't much more of a requirement. If you're selling cover calls, all you have to do is have the stock in your account. If you're selling puts naked, then you need to have the margin requirements to do so. You also need to have the option clearance to do so. But in terms of an order, it's all the same. It's just the difference between a buy order versus a sell order. Brian's asking, you have 3 fields showing on your screen. On initial opening, my screen only has the watch list and chart fields. So if you only have this view and you're missing that third one, then there's a button here on the right that says show trade panel. If you click on that, that will show you that trade panel. What if you want more than 1 or 2 contracts? Then you can click on modify and you can change the quantity, or you can just type it in. So if you want 10 contracts, type it in and then click on the trade button and it will pre-fill that order for you with 10 contracts. You can also use our risk and investment calculator. So let's say you want to risk $2,500 on a trade. Then you can do that and it'll automatically calculate the appropriate number of shares that you can buy, the number of contracts of calls you can buy, and the number of contracts of call verticals that you can buy. Will you be adding a dashboard that tracks your options plays? So that is something that we've already built, and that is something we're in the process of building out, and hopefully offering that out to your clients, to you guys as clients as well. If trading a credit spread, how can you choose the desired credit limit to say 15 cents in the trade window? I'm not sure how you would do that so are you saying, Candy, if you can just, I'd love to answer that question, but that question is deviates quite a bit from our analysis here today about basic strategies. So why don't you shoot me an email with exactly what you're looking for, or shoot an email to your customer rep. They'll be able to forward it on to me, and we'll be able to discuss exactly how to achieve what you're looking for. If I do not need the watch list on the left side of the screen, can I eliminate and maximize the screen of the other 2 columns? I don't think so, to be perfectly honest. Yeah, you're not able to minimize the trade ideas and watch list section if that's what you're asking. I accidentally X'd out of the GYR bars. Green. Just type in a new symbol and see if that works. I think what you mean is that you remove these. Yeah, just type in a new symbol and they'll come right back. Any other questions?
I think that about does it, Tony, as we're past our time, but thanks for addressing all those questions, and thanks to the audience too for asking some great questions. And Tony, great job on going over all the option strategies and the platform. That was wonderful. Thank you.
Yeah, thank you everyone for joining me this afternoon. I really hope you guys find this useful. Like I said, this tool is designed to help make your lives easier, so that you don't have to feel overwhelmed with that option chain, designed to give you ideas and starting points instantly. Just type in a stock, click on I'm bullish, I'm bearish, or income, and be presented with starting points so that you can start learning and analyzing before you start placing your trade. And eOption has a great paper trading account, so I highly recommend for those of you that are brand new, start with some paper trading, see how that goes before you graduate to your live accounts. So thank you everyone for joining me this afternoon, and we'll be back in a couple of weeks with our next webinar.
Yep. As Tony said, thanks for attending today's webinar. Again, if you need to find OptionsPlay on your platform, as a tab across the top. And if you have any questions, any follow-up questions, please contact your brokerage support team. Please give them a call. We do have another OptionsPlay webinar in 2 weeks. We try to put these on every 2 weeks for you. Same day during the week, Wednesday at the same time, 3:15 Central Standard Time. But yeah, be on the lookout for the next email for our next webinar in 2 weeks. Okay, thank you all again, and have a wonderful rest of the day. Bye-bye.